threat to the economy.
So with tariff inflation, there's the announcement of a tariff, and then they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
Hello there, welcome to Commodities. Let's see how the energy complex is doing right now. The American military intercepted and seized a sanctioned oil tanker off Venezuela. Bloomberg says it's a big escalation of tensions between the two countries. And of course, it may make it much more difficult for Venezuela to get oil onto global markets. Other shippers may be loath to actually load up in Venezuelan ports. Most Venezuelan oil actually goes to China at steep discounts, but the Americans making this decisive move of seizing a ship could tighten up the supply pretty radically. Let's have a look at the metals here. Gold is in focus, of course. A disturbing story here from the World Gold Council. Apparently, this surge in prices for the yellow metal to record highs this year has led to a rapid expansion in illegal and informal gold mining around the world. In many cases, this is ecologically destructive, and they also use unhealthy practices, refining, getting the gold out of the rock, out of the ore, using mercury and stuff like that. In fact, this small-scale gold mining is now about 30% of global supply, probably, according to the Council's chief financial officer talking to Bloomberg. He says that in countries such as Ghana, rural populations are abandoning farming and just going after gold instead. And of course, organized crime in many countries is involved as well. Okay, so we're watching Capital Power, the Alberta-based energy generator today. That stock is down, but it does have a deal with Apollo Global Management, the private equity player, to pursue acquisitions of gas-fired natural gas assets in the U.S. Of course, the idea here is that Capital Power would produce electricity, which is in hot demand right now, to fuel data centers. Capital Power also assigned an electricity supply agreement with a data center developer in Alberta. And we're going to be hearing shortly from the CEO of Capital Power. And Chevron and Shell were among the top bidders at the U.S. government's first sale of oil and gas drilling rights in the Gulf of Mexico since 2023. The auction ended with $279 million in high bids, was the first of 30 mandated by U.S. President Donald Trump's tax cut and spending bill. Of course, we have seen a slide in U.S. crude oil prices this year, and that tends to limit investment by drillers. Nutrien, the Canadian global fertilizer giant, could be in the crosshairs now that Trump is proposing what he calls severe tariffs on Canadian fertilizers. His idea here is apparently to support domestic production and benefit U.S. farmers. But of course, it's kind of baffling because earlier America did move to put tariffs on Canadian fertilizers and then brought them down again. Let's get more from Seth Goldstein, senior equity analyst at Morningstar. Seth, thanks very much. for joining us. It does seem confusing, doesn't it? Because Washington initially said, no, we're putting tariffs on Canadian fertilizers, but then cut them. So does he want to do a U-turn here?
Well, it seems like the Trump administration is still trying to work through broader trade agreements. And when it comes to the U.S. and Canada, fertilizer tends to be a large product that is exported from Canada into the U.S. So that's a big bargaining chip for the Trump administration. But I ultimately think if we look at historical precedent, Trump administration has wanted to support farmers. Now, if we're looking at what kind of fertilizers come from Canada to the U.S., there's really two major ones. There's nitrogen and there's potash. Canada has some of the best, lowest cost potash mines, and the U.S. really does not have enough resources to produce its own potash. So I think regardless of what happens, the U.S. would still need to import the vast majority of its potash from Canada, even if tariffs were to be applied. So I wouldn't really see much change there. But with nitrogen, the Trump administration could want to support an increase in domestic nitrogen production, taking the low-cost U.S. natural gas, and that could be where there's some sort of investment or some incentives for nitrogen producers to maybe ship production from Canada to the U.S., or this could just be all part of a broader negotiation, and we see the tariffs get threatened and taken back like we saw earlier this year.
Yeah, it's interesting. The U.S. just does not have nearly the capacity to supply its own potash. We were discussing this earlier, actually, with the CEO of a company called Brazil Potash. There's moves to produce it in Michigan, but that's quite a few years away before they actually get it out from that project.
That's right. We see potash mines take years to build. In fact, if you look in Canada, BHP's been trying to build their new potash mine for over a decade now and still is not close to the finish line. So, new potash mines, this is one of the longer mining project, longer development. And then you look at the U.S. and the geology is just not quite as strong. So you look at higher operating costs, and you may need government support to make the mine viable and profitable, like we've seen in other commodities where the U.S. government has wanted to support critical minerals. And potash is now listed as a critical mineral, so we could see that. But even so, it would likely be years, likely till the next decade, till we start to see a meaningful increase in U.S. potash production.
And U.S. farmers are already suffering because of the trade conflict with China. I know a lot of that's been put on hold, but and China has made some concessions on soybeans, but it's been a rough year for U.S. farmers.
It has been. We've seen fertilizer prices rise, especially nitrogen and potash. We've seen feed and crop chemicals prices continue to rise, and we've seen crop prices generally fall year over year. So for the U.S. farmer, they're getting squeezed on both ends with lower crop prices and higher expenses. And if you add a tariff, that's just an additional cost to the farmer. So that's why I ultimately think we're not likely to see a big impact here, because the Trump administration is going to want to support farmers. That's a big part of the Trump administration's base. And what they've historically supported, a group they've historically supported. So I think we're likely to see this just result in either part of a broader trade negotiation deal or just conjecture at this point that ultimately doesn't go anywhere.
Before we let you go, maybe we'll put up a 5-year chart for Nutrien. What is your verdict on the stock right now, Seth? Does it look like decent value, NTR?
We think Nutrien's undervalued right now, and it's one of our top picks in the basic materials sector because we think the market is expecting potash prices to fall back to where they were last year, while we expect potash prices will remain in the mid $300 per metric ton levels. And this will benefit Nutrien, as Nutrien is the lowest cost potash producer in the world, which underpins our narrow moat rating. Also, we like management's recent capital allocation decisions to divest lower performing retail businesses and potentially sell the phosphate business, which does not generate as strong a free cash flow, while putting money back into the low-cost nitrogen and potash operations, which we think is a good capital allocation approach. So we think shares are undervalued, and we see stronger growth for the company going forward.
Thank you very much, Seth. Really appreciate it. Seth Goldstein is Senior Equity Analyst at Morningstar. Up next, Capital Power has ambitious plans to ride the data center wave. We're going to hear from the CEO after the break. Well, this has been a busy week for the Alberta-based power generator Capital Power. It has penned an agreement for natural gas generation with a data center developer in Alberta. It says it's investment grade. It's working with the private equity giant Apollo Global Management to seek acquisitions of natural gas assets in the U.S. The company had its investor day today. Just out of that is Avik Dey, CEO of Capital Power. Thank you very much indeed for joining us, Avik.
Andrew, great to be with you.
You've had a busy week. Start off with the investor day. Now, the stock is down a bit. It's just one day, I know. TD saying that your guidance for cash flow per share next year marginally below the street, really not very much. We're talking about 2 or 4%. Do you think that might be depressing the shares today? I know it's hard to read one day's move.
I think so, and we have general market deterioration for the IPPs in the U.S.
Okay.
But I think overall we're really excited about where we're going and the growth story around what we're doing. 2026 is a year where Alberta pool prices are down, and we are taking advantage of that to do some key turnaround work at our key assets to position for a big upswing in that Alberta power market that we expect 27 going forward. So, which gives us the conviction for an ambitious growth plan that we laid out for our investors today.
You sure do. I mean, for one thing, you're looking for a 50% increase in your U.S. capacity by the end of the decade.
We are. The U.S. market is expecting a 20% increase in demand for electricity just between now and 2030. And we believe natural gas is best positioned to provide it because it's reliable, it's cheap, and it's fastest to market. And we've established ourselves as the clear leader in providing natural gas-fired power generation in North America. So it's an incredible opportunity for us to aggregate assets and do what we do best, which is optimize them, run them efficiently and safely, and convert it into more dollars and more power for consumers in each of the markets we're in.
I'm just looking at your stock. I mean, it hasn't done all that much over the past year. I know it's up over the past 5 years, but maybe if we could put up a one-year chart, it doesn't. It's down a bit, about 3%, despite all the excitement over power and AI data center needs. Why is that, Avik?
So there's a lot of promise in the market for establishing power purchase agreements with data centers. And there's a lot of conviction in the market for growing electricity demand. We've been very clear in our expectation that natural gas is going to fill that demand, and it's going to fill it for those that have existing assets. So we've seen significant improvement in our overall story, as well as cash flow, EBITDA outlook for growth, and converging on the multiples that our peers in the U.S. have. And for us in particular, I think the market's been looking for us to demonstrate that we can grow in the U.S., that we can in fact convert contracts into longer term contracts, 10 years plus, and demonstrate we can deliver power purchase agreements to data centers, all of which we've done in this past year. And again, that's what gives us the conviction to double down on natural gas and put forward some aggressive growth plans to 2030.
But why hasn't the stock done more amid all this excitement, Avik, would you say?
I think overall, we're expecting to see more positive reaction from the market. We've got a great set of shareholders that value our dividend, our conviction around our dividend. And we've been working towards growth investors that see and put value in the growth potential of the story. And so for us, it's providing that narrative for both growth and value investors. And increasingly, we're seeing that conviction come from investors in Canada and outside, particularly in the U.S. institutional market.
And your yield right now about 4.5%. You're comfortable that you have it covered?
We do. I mean, we have one of the most compelling stories in terms of dividend payout ratio, 30 to 45%. We're investment grade with a very compelling free cash flow yield. So from a leverage standpoint, from a free cash flow standpoint, from a dividend payout ratio perspective, we've got all the ingredients to deliver value through yield and compelling growth.
It must be an exciting time to be in your industry with this massive run-up in power demand.
Well, Andrew, what's really compelling about where we are in the sector is we have two prevailing thematics in the market, both that transcend every industry vertical in North America. The first one being the AI infrastructure boom that's changing the way we live and work everywhere around the world. And secondly, we have a growing reliability gap in our energy infrastructure. And so meeting reliability needs for consumers, meeting affordability needs for consumers means we have to invest significantly into new energy and power infrastructure. And we're looking to capitalize on that and provide that for consumers and customers both.
And we're tight for time, but you are saying that this agreement the Prime Minister, Mr. Carney, made with the Alberta Premier to allow laxer or a loosening of the emission rules on electric power, that opens the gates for you to build big gas-fired plants in Alberta.
We have a very important conversation in front of us as Canadians, which is how do we invest in infrastructure in this country and put capital into this country and create jobs for people in this country. And that comes through major infrastructure investment. The clean electricity regs themselves prevented investment into natural gas infrastructure. And with the repeal of that in Alberta, it opens us up to grow energy infrastructure in the province, serve data centers and critical infrastructure, and provide for economic growth in Alberta and Canada overall. And I'll note on natural gas, on the emissions point, we repowered a coal plant into natural gas and reduced emissions by half. One of the largest decarbonizing capital projects ever done in the country. So 3.5 MTPA per ton. So natural gas is a critical piece to the decarbonization story in this country and globally.
Thanks. Yeah, of course, the Genesee rework there you're referring to. Avik, thank you very much indeed.
Thank you, Andrew.
Avik Day, CEO of Capital Power. Up next, soybean futures in the U.S. falling to their lowest in nearly 6 weeks, although they are up in the past year. The Chinese agreed to buy a whole bunch of U.S. soybeans, but their purchases have been relatively slow so far. We'll drill into that after the break. As part of the trade armistice between Washington and Beijing, the Chinese agreed to purchase 12 million metric tons of soybeans from U.S. farmers, but they haven't been buying that many. Now, apparently, there was confusion or a misunderstanding over which season we were talking about. Is it the end of the growing season? And it wasn't apparently meant to be the calendar year. Without getting too deeply into that, our guest says this deal is political. In fact, China doesn't actually need soybeans from the U.S. It can get it from other sources. We are joined by Amanda Xiao, Director of the China Practice at Eurasia Group. Amanda, thank you very much indeed for joining us. I know we can't dwell on it, but the Chinese have been slow, apparently, to buy all these soybeans.
Yeah, that's right. So the Chinese stopped purchasing U.S. soybeans shortly after Trump imposed tariffs earlier this year. But we saw that purchases began to gradually increase after Xi and Trump met in South Korea, after which Washington said that Beijing had committed to purchasing the 12 million metric tons of soybeans before the end of the year, but also that they pledged to purchase 25 million metric tons each year over the next 3 years. Now, it's going to be hard for China to buy all 12 million metric tons of soybeans by the end of this year. So far, they've purchased about 3 million metric tons. And we've seen, as you alluded to, public remarks from Trump administration officials that suggests that the U.S. is showing some flexibility, and they have in fact pushed the timeline back. We've heard that Secretary Bessent is now saying that the Chinese will fulfill this pledge by February of next year.
And you say strategically the Chinese can go elsewhere for their soybeans to suppliers such as Brazil if they need to.
Yeah, I mean, the decision to buy U.S. soybeans is fundamentally, political for China. I mean, Beijing doesn't need a lot of soybeans from the U.S. Since the first trade war with Trump, Beijing has really sought to diversify its sourcing of soybeans, right? We saw the U.S. share of the Chinese market drop from about 40% to 20% between the first trade war to now. And it's increased its purchases from Brazil. And so, we've seen that the Chinese have really effectively diversified its purchase of soybeans. So their commitment to this deal is really based on a political desire to maintain stability with Washington.
That's interesting. Well, U.S. farmers have had a rough year, though, not just because of the Chinese cutting off soybean purchases, but that's hard on Trump's base as farming supporters.
Yeah, and the Chinese understand that. They see that this is a politically salient issue for President Trump. And they very much want stability in this relationship, right? And we've seen also that with these sorts of remarks coming out of Trump administration officials, this sort of flexibility that they're showing, that this is a signal that both sides are really committed to making this deal that came out of South Korea work. Now, Beijing's purchases might well be delayed into next year, but our expectation is that they will eventually meet those commitments. Since the two leaders met in Busan, the two sides have really been following through on their commitments. So they made a number of other commitments not related to agricultural products, but also to rare earths, to cooperation on fentanyl, et cetera. So I think what we're seeing on the whole is pretty clear signaling from both sides that they want to stick to that truce.
Thank you very much, Amanda. We'd love to have you back because you've done a lot of work on China and its security concerns, Taiwan, its relationship with India, and we'd love to have you back on its aggressive policy, for example, when it comes to things like rare earths. Really appreciate it.
Thank you very much.
Amanda Xiao has been our guest director of the China practice at Eurasia Group. Thank you very much indeed for watching Commodities. We'd love to hear from you. Please email us, commodities@bnnbloomberg.ca. The close is next.